very fragmented market. There are three big players, Gestamp, Magnet, the Canadian ones that are listed, and Benteler, the Austrian company that is privately owned. And you can see they are a tier one player. They are a strategic supplier to the OEMs. They sell directly to the OEMs. In terms of the car, in the weight of the car, the components of the car parts that Gestamp sells represent 32% of the weight of a car. And if you look at in terms of value, is 12 to 15%, depending if it's an internal combustion engine or an electric vehicle. In terms of global footprint, you can see they have plants in 22 countries. They have 180 different plants. They are building 4 additional plants in Japan. They have just finished it in Slovakia, UK, and Poland. They have a global presence, a global manufacturing presence that is very important for the global OEMs. You can see that they work with every one of the top 12 OEMs, automakers. They have 13 R&D centers across the globe, more than 43,000 employees, and they work currently in more than 900 different vehicles. So they are very diversified in terms of all their models and the segments that they sell their parts. So let's think of what are the mega trends in terms of the auto and parts business, and starting with the OEMs. What's happening in terms of the OEMs? In the past, they wanted to be vertical integration. They want to have a global footprint, and they wanted to have the control of the powertrain and the engine. This is the past of the auto industry. But you can see that, and we all see this in the press, that is changing a lot. Now you have stricter regulation in terms of safety, but more importantly, in terms of CO2 emissions. Then you have the customer expectations. You can summarize it in the acronym of the case: the connectivity, the autonomous vehicle, the shared mobility, and the electric vehicles. These are what the customer wants. And then you have the new entrants in the old-fashioned industry. We all know about Tesla, how disruptive this company has been to the sector. And what we think is happening here, it's the effect of Tesla. It's waking up these sleeping giants that are starting to react, and much quicker than we should expect for companies of this size and such a old age. You can see they are increasingly basing their outsourcing of some car parts. They no longer want to be vertical integration. It's a way to save Capex and reduce their Capex and reduce their investments. They're increasingly going for global platforms. You have the case of Renault Nissan, that they will have 25% of their models use the same platform, and they want to reach to 75%. You have increasing consciousness about the CO2 emissions. You have the investments needed to enter the electric vehicles. Then you have other drivers. The automotive production grow. The automotive sales continue to increase around the world. You have the safety requirements, and they're even more stricter every year. And then you have all the comfort features that the customers are demanding. So let's start exploring what are the three dynamics that helped to explain the big success that Gestamp had in the past, and why do we think that these will continue? First, we have the global automotive production growth. We've seen today these statistics that 2% market growth between 18 and 22. But I think what's important here to analyze is to break down where this growth is coming from. If you see in 2012, 72% of the auto production growth was coming from mature markets and just 28 from developing markets. And now this is changing dramatically. You can see that mature markets are expecting to remain basically flat. They're increasing 0.5% a year. But if you look at developing markets, they are growing at 4% a year. So in 2022, we'll reach a stage where the developing markets are going to dominate the auto manufacturing with 55% of the production capacity. And this is where Gestamp is currently investing. They are investing in Asia, they are investing in Eastern Europe, and they are investing in the North America. And North America is a mature market, but not for them. For them, they were a very low market share, and they are gaining the opportunity to increase their exposure here, as we can see in a couple of slides. And then you have here the outperformance of Gestamp versus the auto production. Since 2010 until 2011, the market was up on average 3.2% a year, and Gestamp revenues went up 13.2% a year, so a 10 percentage points outperformance. And if you can see, they've achieved this outperformance in all the main regions where they are present. It's incredible. Now let's try to explore the second big opportunity that Gestamp has in this market, and that is the outsourcing potential. In this map, what you can see here, it's the majority of the components of a car are already outsourced to third parties. The exception is three big parts. It's the transmission, it's the engine, and it's the body in white and the chassis. And this is where the Gestamp is present, is their segment. In terms of engine and transmission, we see that the autos OEMs continue to be very reluctant to externalize or to pass it to other parties, the development of their own engines. But in the case of the body in white and chassis, they are increasingly outsourcing it because there's no differentiation here. Of course, the design of the cars continue to be done in-house, but at the end of the day, you don't care who's making the door of your car, if it's Volkswagen, or if they are outsourcing it to Bentley, Magna, or Gestamp. So, and the auto OEMs are seeing that this could be a great driver of reducing their Capex needs in the future, given that we are going to see a technological change for the sector. In terms of their addressable market, the auto components market, it's worth 725 billion a year, of which 108 billion, it's the parts where Gestamp is present, and 130 billion, it's the body in white and chassis. We leave mechanisms apart. And if you can see, in 2015, you have 43 billion, or 42% of the market was outsourced. And what you can see, it's in 2025, we are expecting to see 63 billion of outsourced market, or 50% of the market. So Gestamp addressable market will grow by 20 billion in the next years, and this is a growth of 4% a year. So you're growing the 2 times the speed of the underlying car production market. So this is one of the reasons that they are growing a lot, because the OEMs are outsourcing, and they want to outsource to the global players that have the scale and the capacity to go and internationalize with them. Then you have the CO2 and the safety regulation. As you all know, auto OEMs are having, in terms of regulation, is forcing them to reduce a lot the CO2 emissions. And you can see here that the biggest driver of CO2 emissions, of course, is the engine, but after the engine is the weight of the car. And so they have to reduce the weight of the car, and at the same time they have to improve the safety standards of their cars. And how can they do it? They can do it with new technologies in the sector that is called hot stamping. And we have here the XC90 case study. We have here the first version of the XC90 had only a 7% content of hot stamping. If you go to the latest version, it has 38% of hot stamping. So you have 60 kilos weight reduction in terms of your car. This allows you to reduce 6.5 grams per kilometer of CO2 emissions, and at the same time improve the safety of your car. And here in terms of weight reduction, for every 100 kilos that you reduce the weight of the car, you reduce the CO2 emissions by 9 grams, which is a lot if you remember that they have to comply with a 90 to 95 grams in 2021, 25, depend on the market. And this is how you can see the evolution of hot stamping. Hot stamping is the new technology that in 86 it was just 1% of the market, and in 2016 is growing to 38% of the cars produced by Gestamp, not the market. And this is a big opportunity for them, because if you want to, traditionally the autos OEM had their cold stamping plants, production lines, but you can't upgrade a cold stamping production line to hot stamping. You have to invest in the new production line. So, and OEMs, what they are doing, they are reducing their investments by outsourcing this to auto parts like Gestamp. A new production line could cost you 60 million euros, and it has a ramp-up period of up to 5 years. So this is the third driver of growth for Gestamp. Gestamp hot stamping represents 25% of Gestamp revenues. 100% of the hot stamping lines are outsourced, and it has higher margins than the traditional cold stamping. If you can see here, the hot stamping market is growing 11% a year between 2015 and 2025. So this is a growth of 11% a year. So it's more than 5 times the growth of the underlying market. And you can see the number of lines, hot stamping lines. Gestamp is the number one with a 25 to 30% market share, and they have a big competitive advantage. They produce their own hot stamping lines. They produce their own toolings and dies and presses that the Benteler and Magna, they don't produce it. They have to rely on third parties. Then we're going to Capex. Capex is one of the big cash pushbacks of Gestamp investment case. Everyone is questioning why are they investing so much, but we don't see it like that. We see it as an opportunity, because Capex is high, but it's high not because they have delays or cost overruns. The Capex is high because they are winning a lot of new orders from their clients. So the Capex last year, it was 11% of sales, and it's going down to 7 to 7.5% of sales in the next 5 years. That will increase a lot the free cash flow generation. And if you see from this Capex, 1.8 billion of Capex was, in the last 5 years, was invested in growth Capex. And going very quickly here, how this growth Capex will translate in the future. For every 100 million euros they invest, they have a ramp-up period of 5 years, and this 100 million will translate in 150 million of revenues in year 5, with an average margin of 15% EBITDA margin and a 12% return on capital employed. So this 1.8 billion will translate in additional 2.7 billion sales in the next 5 years, and an additional 400 million of EBITDA. And contrary to the most auto suppliers, the electric vehicles, for them, it's a big opportunity. They don't have any exposure to internal combustion engines. They are technology agnostic. Their technology goes to every car, being powered by an internal combustion engine, on an EV, on an hybrid. It doesn't make any difference for them, but it's an opportunity because they have battery boxes. It's a new product that would cost 500 to 600 euros per car additional, and they are already working with several OEMs, and the most famous one, Volkswagen, with their map platform. They are already developing this platform for them. Another key source of opportunity for them, it's Japan, China, and India. If you look at Japan, it's 28% of auto production, and it's just 7% of revenues. In the case of China, in India, it's 15% of auto production and just 1% of the revenues, and they are investing a lot. That's why they brought Mitsui to their capital structure that is opening the doors there. They have won a big contract with Honda in Japan. They opened a R&D center, a new hot stamping plant last October. In China, another R&D plant, and they have signed a joint venture with BHAP. And to finish, the balance sheet. The balance sheet is the other pushback that the people point out in Gestamp's investment case. They have a 2.3 times net debt to EBITDA, but you should remember that more than 50% of their debt, more than 1 billion of their debt, is attached to projects that are still on ramp-up stage, that have negative EBITDA, or continue to be quite dilutive. Well, this is one of the reasons why the debt doesn't worry us. The second one is in terms of high visibility of their order book. They have a total visibility of 90% of their revenues until 2021. And then you have the resilience of their business model in 2008 and 2009. In the global production went down 17%. In the case of Europe, it went down by 27%. And if you look at revenues for Gestamp, they went down just 12%. It was the best performance in their peer group, and the EBITDA was down just 17%. It was the second best performance in the peer group. They managed to reduce debt in this period, because they have a very flexible Capex and cost structure. So to finish our valuation, in our base case, the stock could almost double, just assuming revenues will increase and profitability margins will increase from 11 to 12%. Our base case is almost triple the current price, just if profitability continues to increase, and the current scenario that there's no revenue growth, very conservative, and no profitability improvement, you continue to have an upside from current levels. Here are the risks. The main risk that we see here is execution risk if they have delays on one of their projects, or cost of overrun. The rest, I think they are all manageable. High Capex, FX, the leverage we've talked about, or technological changes. We don't see it. They are the technological leader in this sector. And just to finish the summary, I would highlight the very attractive valuation. The stock is trading at 0.6 EV to sales, 5 times EV EBITDA 2019, and the price earnings of less than 10 times. For a stock of this quality, it's a 10% return on capital employed that continues to be very diluted by the greenfield projects, and this return on capital employed will continue to increase a lot. Thank you very much.
Thank you, Diogo, for a good presentation. I believe Volkswagen is 25% of your business.
Yeah.
And so 2 questions. How easy is it to switch for a Volkswagen from Gestamp to another supplier? And second question is, Volkswagen has like 4% EBITDA margins, and this supplier like 3 times almost. So, and with the new CEO at Volkswagen focused on cost cutting, do you expect more pressure for a company like Gestam on their pricing?
Yeah, that's two interesting questions. Volkswagen represents 27% of their revenues, but not Volkswagen brand, the Volkswagen Group. But they work with every brand and every segment of Volkswagen. So they are diversified. That's one of the risks that we see. And that's why the company is also pushing to diversify to the Japanese OEMs. They just work with Honda. They're trying to explore, to enter with Nissan and Toyota, and they're trying to enter in South Korea with Hyundai, and they're trying to enter in China with this new joint venture. So they are trying to diversify. There's a concentration risk, of course, but if you think these are tier one suppliers, all these tier one suppliers have these concentration risks because at the end of the day they sell directly to the suppliers. So it's part of their business model, and I think in 5 years' time you'll see much more diversification, and the weight of Volkswagen will go down. But it also shows the resilience of their business model. After the Dieselgate scandal and after this Volkswagen suffered, they didn't suffer a lot. They continued to increase their sales. In terms of pressure, there's two parts. There's the more commoditized part of the business, the cold stamping, the traditional business, that they have pressure from suppliers. And they have to, in China, for instance, it was Volkswagen in the US and BMW in China. They outsourced part of the cold stamping business to third parties, local players. And they had huge problems last year. They had to call Gestamp to save the project and to take up the control of these plants and to help them. Of course, they're in the commoditized business, there will be success stories. They can replace Gestamp by other players. But here in the hot stamping business, there are three players. The OEMs, they don't invest in hot stamping. I think in the big players, Volkswagen and Fiat, have some small investments in hot stamping just to understand the technology. They don't want to invest here, and there's a lot of demand from this project. So Gestamp and the others can be very selective in the projects that they accept. And don't forget, when you accept a project, you accept the project for the whole lifetime of the car model. So you will be working with them with a 5 to 7 years horizon. So during this time, they can't change it, and that's why they have this big visibility until 2021.
I'm going to ask you the same question that Christian asked me. Could you tell us a bit more about the management structure, the family, who's in charge, and the management structure? It's a family-owned business.
Yeah. It's owned by the Rivera's family. They own 57% of the company, and the chairman is Mr. Rivera's. Is there. We have a lot of contacts and meetings with them, and we think it's a fantastic business. They did the IPO because they had, as I explained, ArcelorMittal had a 35% stake on the company. In 2016, when they suffered a lot, they did a capital increase to deleverage. They announced they were exiting the non-core business, and one of the investments they exited was Gestamp. So the family bought back from ArcelorMittal the 35% stake. They sold 12.5% to Mitsui, and then the rest they had to deleverage. So that's why they did the IPO, just to deleverage the family. And because they had bought back this stake from ArcelorMittal. They are long-term owners. They are the founders, and we continue to see they like the business. They have other investments in the sector. They are the largest shareholders of Automotive and other Spanish OEM suppliers. So.
The CEO is part of the family or external?
The CEO is external. The chairman is the executive chairman is from the family.
So thank you, great presentation. You know, we also have owned parts suppliers to the OEMs. And I guess this question should probably apply to everybody who's going to talk about auto parts suppliers. But one of the things we've been really concerned with is autonomous vehicles and the potential impact it could have on demand. And I'm just wondering, with your evaluation scenarios, if you guys have factored that in, or even, you know, how you're thinking about that in regards to this opportunity.
I think that's a threat for the sector, and I think the autonomous vehicles, every one of us could have their view and their opinion here. In terms of if you have an autonomous vehicle, a full autonomous vehicle and others level 4 or level 5, I think will take a lot of time. And even when it comes, I don't know if it's going to be here in 2025 or 2035, people will continue to be worried about the safety of their cars. So at the end of the day, you're not going to turn your eyes or turn your attentions from safety when you're talking about 10% of the cost of making a car. It's not such a big part of the car, and it's something that's very, very as fundamental for customers, for OEMs, for regulators. So in terms of their business model, I think that won't change a lot. I think, and if it comes, it was a long-term attraction. I think what you mean is if you have autonomous vehicles, you don't have, or you have less accidents, so you don't have to have safer cars. I think that's the point you're making, but I don't think that's a risk.
Hi, Diogo. Thank you very much for the presentation. I have 3 points to ask, and don't misunderstand me, because I think Gestamp is a great investment, but 3 points that concern me. First of all, with the platform simplification that is going on, reducing the amount of platforms for all across the board for the OEMs, don't you think that this could sort of affect Gestamp in the future with a reduction of variations and amount of products that are ordered by the OEMs to Gestamp, first of all? The second question is consolidation that is going on in the sector seems to be like not a fact, but something like a trend, and it's going forward. So very possibly we could see in 5-6 years out, instead of 12 big OEMs, just 6. And this sort of concerns me in terms of the margins. I don't know if with the pressure that these guys are receiving in terms of emissions regulations and how much Capex they have to put in the whole EV and so on, if eventually Gestamp will have a 12% EBIT margin, or sorry, EBITDA margin, whatever, in 4 years' time, or this will be closer to 11%, which they have now. So that's another question. And the third one would be, you have mentioned that one of the risks is the high Capex level going forward. My view is that for Gestamp, I don't think that they really have the choice to reduce Capex. I mean, they have to continue growing side by side with their clients forever if the client asks for that. So I don't know if after this Capex plan that they have for the next 4 years, if after this Capex plan they will have to get involved in another big Capex plan. So this will continue going on forever. And although you and I, we can see the embedded value in that, I don't know if the market will ever see that embedded value in a leveraged company. Although it's very difficult to predict what the market is going to do, impossible. But if they continue growing as always, and they are highly leveraged, and they continue, you know, with this Capex, whatever, 10 years, if the market will ever recognize the value over there.
Mm-hmm. Okay, very interesting questions. Let me see if I don't forget to reply to you. Okay, here. First, I think that the two first questions are really connected. First, the OEMs sharing their platforms and consolidation. We don't brought it here, but it's another opportunity. It's not a risk, because at the end of the day, this is a very fragmented industry. You have Magna has a 17% market share in body in wide and chassis, and Gestamp has a 13% market share. So all the other competitors are regional players. And if you go for a sharing platform for the biggest OEMs, or a consolidation from whatever companies you could be thinking of, at the end of the day, the players that have the scale, the global footprint to being around with these mergers, with the new, after the wave of consolidation, it's the global players. And on the global players, you just have the three main ones. It's Gestamp, Benteler, and Magna International that have presence in are represented in the all main markets. If you look at Asia, why are they are growing so much in Asia? Because Asia, you just have the regional players that just control the very basic technology. They don't have the Capex to invest. They can't invest in plants, and they can't invest in R&D. These guys invest 2% of their sales in terms of R&D. It is 2% of a company that sells 8.5 billion. It's a lot of investment in new technologies. And technology is continuing to evolve. We first had cold stamping. Now we're starting to see the penetration of hot stamping, and in 5 years' time, we're going to be talking about aluminum. And these guys they aren't even in hot stamping, not to talk about aluminum. Gestamp is just this plant that they are opening in Slovakia. 80% of their sales are going to be aluminum. They are much in front of the technology of the company. And in terms of Capex, that's the risk. I think one of the things that the market didn't like, it was in 2018 that they had, I think, a 10 or 10.5% Capex to sales guidance, and at the end of the day was 10.8%. But the justification that they gave, it's very interesting, and I think everyone understands. You are Gestamp. You got a call from Volkswagen. I want you to be in the map platform where I'm going to invest 30 or 40 billion in the next years. What are you going to do? You say, no, I don't want to participate. I think this is very wealthy growth, and I think if they continue to invest for the good reasons, because they are investing because they are winning projects. They are not investing waiting the projects to come. That would be a risk. No, they just invest when they have a project from Volkswagen, from Toyota, from somewhere else, and they see the earnings visibility for the next 5, 7, 10 years. So this is wealthy Capex, and if the market doesn't want to wait or wants to see the Capex coming down, that should start to come down in the second half of this year, and it should start in the next 5 years to go to this 7.5 or 7.5% of sales. That could represent an additional 300 or 400 million additional free cash flow, and at the same time maintaining growth. Because in terms of maintenance Capex, if you see here, their maintenance Capex is between 4 and 5%. And this is Capex that will allow them to grow in line with the sector. So we work with different time horizons with the market. We can wait, we can have the patience to wait, and because it makes sense. And at the end of the day, this will create a lot of value for all the shareholders. And we are aligned with a family that are the biggest shareholders in the company. Yes.